Hey everyone, welcome back to the channel. So today we'll talk about a stock that's controversial. Some think it's dying, but I think the market is wrong. I'm talking about Coal India, and even though it's down 2% since I added it to my 2025 portfolio, I still think there's a 34% upside, and in this video I'll break down exactly why. But before we start, I'd like to say that this isn't financial advice and I'm not giving you any buy sell recommendations. So always do your own research before investing and please read the disclaimer. Okay, so here's some terms that I've used throughout the thesis so you can come back to these and refer to them if you don't understand them. So Coal India is the world's largest coal producer. It's a government owned PSU, which means public sector undertaking. This means that the government owns the majority stake, 66.13% to be exact, and it plays a strategic role in India's power, steel, and cement sectors. It supplies more than 75% of India's coal, and it has a dividend yield of 6.7%, a return on equity of 38.8%, and a price to earnings ratio of 6.9. It owns more than 350 mines across 8 subsidiaries. Basically, Coal India is the spine of India's energy system. Another thing to note from this slide is that historically, Coal India stock has always traded above its 50 and 200-day moving averages. But right now, it's currently trading below it, showing how the market is currently bearish on it. Now let's move on to industry analysis. Now yes, India is pushing for 500 gigawatts of renewables by 2030, but coal still generates 70% of electricity today. Solar and wind are growing, but they're intermittent and storage is nowhere near ready. That's why coal demand is projected to rise to 2035. And Coal India, with more than 80% of the market share, is at the heart of that. The graph provides a good visual representation of that. Another thing to note is that coal imports are falling, and near term challenges to renewables position Coal India favorably in this environment. Now, here's why I believe that Coal India is mispriced. Firstly, market overreaction to ESG. There's a global decarbonization sentiment that has led to people being bearish on coal companies. But India needs coal to 2035, as I mentioned. Demand for coal is not going away, which is my second point, and I'll explain why demand has been weak this year, causing the price of the stock to fall. I'll discuss the major catalysts that I believe will eventually lead to a re rating, and I'll discuss the fact that Coal India is actually diversifying into forward looking projects that will help in the future. And finally, I'll discuss why cash flows are undervalued in my opinion. So let's start with the market overreaction to ESG. While people look pessimistically towards a company that produces most of the coal in the world, we have to realize that Coal India is owned by the government, which has a net zero emission goal. So the company has to comply with this as well. And despite the fact that they are currently producing the most amount of coal that they have historically, this can be attributed to a deep integration in India's national security. But Coal India is moving in the right direction despite this fact because they're diversifying into renewables and they're aligning themselves with government climate goals by adopting greener logistics. Now let's talk about the demand for coal. Coal demand is not reducing anytime soon, with India's energy consumption set to double by 2040, caused by increased industrialization and rapid urbanization. So, despite the fact that renewables are growing, they cannot offset all the energy produced by coal because they are cyclical in nature. And what I mean by this is that solar panels produce more electricity in the middle of the day and less electricity in the mornings and evenings because of the rotation of the earth and sun. Similarly, energy produced by wind turbines is cyclical because they receive higher amounts of winds during certain months and lower winds during other months of the year. Hydro energy too depends on weather patterns. Thus, coal provides a stable flow of electricity as seen uh, in the chart on your bottom right. Now, you might argue that renewable energy can be stored, which is true. However, it will take time, effort, and money to set up the infrastructure, and thus, in the short to medium term, coal is still our best bet. Now, let's talk about the main point. which is our catalyst for growth. The first one is thermal power targets. As I mentioned, our electricity consumption is expected to double by 2040, and most of this electricity is produced in thermal power plants, which run on coal. And so, an increase in demand for electricity will lead to an increase in demand for coal. As we can see from the graph, India's capita electricity consumption is very low compared to the rest of the countries on this graph, suggesting that there's huge room for improvement. My next catalyst is policy push for energy and self sufficiency. Simply put, it's in the government's best interest to reduce imports and become self reliant by using domestic coal, and this will also directly benefit Coal India as imports are being reduced and will continue to be reduced in the future, as seen in the graph. Our next catalyst is margin expansion. Margins are expected to increase since more energy is being supplied to the power sector that pays better. Coal India will hike prices if they need to, and increasing volumes spread fixed costs, causing margins to increase. And talking about costs, employee costs are decreasing since hiring is slower and retiring employees aren't always replaced immediately. Moreover, the newer investments that Coal India is making is increasing efficiency and lowering the costs. And finally, operational costs are set to decrease as Coal India is reducing their dependency on outside contractors. Next up, let's talk about e auctions. So, Coal India sells around 10% of its coal through online auctions, and this is where the real margin magic happens. While global coal supply is tightening, especially as Indonesian imports decline and demand from India and China is rising, auction prices can go up sharply. And these aren't small premiums either. E auction prices can be 30 to 50% higher than normal contracted sales. So, if global prices stay firm, Coal India could see a meaningful bump in profitability through these high margin sales. Coal India also gives out consistent dividends, 79.5% on average. These high dividends are sought by investors who seek stability in a volatile global market like we have right now, and future payouts are likely to stay healthy. Now, let's talk about a less obvious catalyst: accounting. A change in accounting standards, specifically the stripping activity provision reversal, will lead to a boost in reported profits and improve return ratios like ROE over the next several years. This is essentially non cash recurring income that makes the financials look stronger, even if operations remain flat. And finally, capital expenditure is picking up. Coal India is ramping up capex to expand mining operations, which directly translates to higher production capacity. This graph shows the rising investment trend. Plus, these new projects include thermal power plants, solar parks, and mine expansion, all setting the stage for future growth. Now, let's talk about diversifying, because this is the key to Coal India's long term relevance. Why diversify now? Because India is targeting net zero by 2070, and coal, being a polluting and finite source, won't stay dominant forever. So, Coal India is getting ahead of this curve. They're working on multiple fronts, installing 3 to 5 gigawatts of solar capacity, investing in green hydrogen and ammonia projects, exploring critical minerals like lithium and cobalt, and leveraging their mining expertise to do so. They're also working on coal gasification to make coal usage cleaner and more sustainable. From a strategic standpoint, I think they're executing this transition smartly while still capitalizing on their core business. On the right side here, you can see all the various joint ventures that they have entered. Let's be clear, no investment is perfect, and Coal India has its challenges. Firstly, there's the quality of coal. Most of the production growth is coming from low grade coal, like G11 and G13, which has lower calorific value. That means even if volumes do go up, revenue per ton might stay flat or decline, limiting margin upside. Second, thermal power plants in India are expected to run at lower plant load factors or PLFs. In the future, as renewables grow, this could reduce long-term demand for coal from key customers like power utilities. Thirdly, captive and private mining is rising. Companies like NTPC and JSW are ramping up their own coal production. The government also wants to expand commercial mining, and that will take market share away from Coal India. Moving on, e auction prices. I previously mentioned that they could increase, but they could potentially decrease as well because currently they're higher than their historical averages. But again, it's difficult to say. But in the latest ConCall, management mentioned that they would remain between 30 to 40%. And finally, while the government wants to reduce imports, domestic coal can't fully replace imported coal in certain plants. Imported coal has better quality, and switching would require costly plant upgrades, which aren't happening fast. So, yes, there are risks, but in my view, most are manageable, and many of these are already priced into the stock. Now, let's talk about the valuation, and this is where things get interesting. Coal India trades at a price to earnings ratio of 6.9, a price to book ratio of 2, and a EV EBITDA of just 3.6 times, all of which are below its historical averages as well as its peers. For example, Tata Power trades at over 30 times earnings despite lower profitability. I also ran a dividend discount model using a 4% dividend growth rate, which is extremely conservative. Even with that assumption, we get a fair value of 500 rupees per share, implying a 34% upside from current levels. In reality, dividend growth has averaged 14% recently, and the market seems to be pricing in just 1.94% growth, which I feel is overly pessimistic. So, even in the worst case scenario where Coal India has low growth, it looks fundamentally undervalued, and you're still getting a 6 to 7% dividend yield while you wait. Finally, let's compare Coal India with some of its listed peers, and the valuation gap is massive. Coal India trades at a price to earnings of just 6.9 and an EV EBITDA of 3.6, while Tata Power trades at 30 times earning and Lloyd Metals at 33 times. Yet, Coal India has the highest return on equity at 38.8% and the highest dividend yield at 6.7%. Even NTPC and NLC, which are closer peers as government backed power or energy players, trade at significantly higher multiples despite lower profitability and lower dividends. So, from a peer comparison standpoint, it's pretty clear. Coal India is severely undervalued relative to its fundamentals. The question is how long before the market corrects that? Let's take a quick look at the shareholding structure. So, I mentioned before that the Government of India holds a consistent 63.13% stake. This shows strong long term support. This isn't just a PSU, it's a strategic national asset, and the government has every incentive to ensure its success. What's really interesting is that foreign institutional investors, or FIIs, have recently reversed their selling streak after bottoming out at 7.74%. Their stake has risen back up to 8.16% as of June 2025. And that's a clear signal of renewed global interest in Coal India, despite the bearish narrative. Domestic institutional investors, or DIIs, continue to hold steady at 22 to 24%, which reflects strong domestic conviction. And the public shareholding is also inching up, a sign that retail is slowly waking up to the opportunity. Overall, their shareholding pattern tells me that there's a silent accumulation happening, and that's something investors should always pay attention to. Next, here are some key takeaways from the recent Q4 FY25 conference call. Coal India has guided FY26 volumes at 875 million tons, with FY27 expected to hit 900 million tons. Massive numbers which stand out. And what stands out even more is that 10 to 20% of this will be sold via e-auctions, and management expects premiums of 30 to 40% to be sustainable. Also, first mile connectivity, or FMC, is improving. They're targeting 100 rakes per day by Q2 FY26. This essentially means that they're improving the on ground connectivity and the railway network. This will reduce logistic costs and improve delivery speed. On the strategic side, they've committed to 80,000 crore rupees in capex over 5 years, covering diversification, mine development, and even thermal power. The gasification joint venture with BHEL and washery monetization are early, but they're promising. On the risk side, legal uncertainties over mineral taxes, rate delays, wage negotiations, and auction pricing pressures are worth watching. But overall, this ConCall shows a company that's aggressively reinvesting to future proof its model while protecting cash flows. Now, let's find some answers in the ConCall transcripts. So, why was demand weak in FY25, which is one of the reasons why the stock price fell? In fact, demand was actually not weak in FY25. In fact, customers wanted more coal than what was produced, especially in sponge iron clusters and power utilities. However, there were problems with two of Coal India's subsidiaries, CCL and SECL. SECL had problems with heavy rainfall and land acquisition issues, and CCL had delays in environmental and forest clearances. Moreover, there was problem with infrastructure bottlenecks, which Coal India is working on. There was a rise of captive coal production from private players, and also e-auction demand was weakening. As I mentioned, the premiums were extremely high and were bound to come down to the average levels of between 30 to 40%. So, why is demand expected to increase in the future? This is because of strong non power demand, reduction in import substitution, as well as strong growth in the power sector. And Coal India is positioned really well to capture on this growth. Another concern I had was, is this huge capex investments in the future going to reduce Coal India's payouts or dividends? In fact, it's most likely that it won't, because Coal India has maintained dividends even when its cash flow was weak, and right now its cash flow is robust. In fact, cash will fund high return projects, which will indirectly support stable dividend growth in the future. So I'm not worried about that. Coal India isn't dying, it's evolving, and the market hasn't caught up yet. So even in a conservative scenario, I see a 30 to 35% upside. Now, if you found this video useful, like and subscribe, and I'll be covering more value picks like this soon.